your investors and your viewers are looking for ways to invest in this macroeconomic backdrop that we find ourselves in, which is tricky. It's not an easy environment to be investing in, but Vox was built for this period of time.
Today's guest is a supporting sponsor of Liberty in Finance. Welcome back to Liberty in Finance. We have a returning guest we've had a couple of times before. This is Kyle Floyd. He's the CEO and chairman of Vox Realty. He's joining us again this Tuesday, July 27th, 2021. Kyle, thanks for coming back on.
Thanks, Diane. Always an honor. Thank you.
You've opened the eyes of our viewers and myself quite a bit in the past visits, talking to us about what the differences are between royalty companies and other types of companies that are involved in the precious metals space. And you've talked to us about some fairly dramatic claims and expectations that Vox has had about their number of royalties and under stream, that sort of thing going forward. We'd like to get an update from you, but I understand that just this week you have a press release that's come out, big announcement. So why don't you get a chance to explain that to us, why it's important, why people need to be aware of it. And then we have some viewers' questions and a technical stumper to throw at you at the end. So we got a whole variety of things here. So but could you kick us off with your most recent press release?
Yeah, well, it's exciting to be back, Diane. And we've been talking a lot about in our discussions together, this big macro backdrop, inflationary pressure, discontinuity in supply chains, and just the really interesting year and a half that it's been, and what effect that's going to have on investors' portfolios, and then specifically in the context of precious metals and mining companies and the commodity sector, generally speaking, which we obviously fall into. And we've been talking now, and I think we've done a couple interviews together about how inflation and high commodity prices really help royalty companies, and I believe are one of the best risk-adjusted ways to play the commodity sector. And this news that you referenced, I think, really highlights just how this type of environment really benefits a company like Vox and shareholders in Vox. And so what I'm pleased to report and announce is that we've recorded record revenue for this second quarter of 2021, over 1.6 million Canadian in top line royalty revenue. And on the heels of what has been exponentially growing revenue over the last 4 quarters, 492% on average, I'm pleased to report that we're doubling our revenue guidance from what had been between 1.7 million and 2.5 million, now to between 4 and 5 million. And so that's a very, very big and significant event for the business and for our shareholders. But it's a result of very prudent capital allocation, very good technical work by our technical team. And then again, the backdrop that we're seeing in the commodity sector, where inflation and very, very high prices in metals, I think likely also going higher, has had a dramatically positive effect on our portfolio, and at the most tangible level, the revenue that portfolio is generating for our shareholders.
So you had already talked to us on your previous visit about how you expected to end the year with almost twice as many royalties under providing revenue to the company than were at the beginning of the year. I believe I might have those numbers not quite right, but it was a very dramatic increase in number. This is different from that. This is saying even with that as a backdrop, you're doubling your income guidance. Is that right?
Correct. So you'll recall we went public in May of last year with one production stage asset, and very candidly, as we've spoken about on your show, that was a knock against Vox. But we said, look, we are allocating capital in a very disciplined fashion, and we're really looking for royalties that we think are going to outperform. And that's exactly what we've done and exactly what we delivered on, and we continue to deliver on that. So we went with one producing stage asset. We had one production stage asset when we went public. We're now sitting at 5. There's another asset that's in commissioning right now that we expect to be a very large contributor over the next few years at a revenue level for us. And that continues to grow. So that producing asset count continues to grow. It's the fastest growth rate at a producing asset count level in the industry. And also now, as we said, we would be the fastest growing company from a revenue perspective as well.
So could you help our viewers understand why the guidance is being changed? It's raised significantly, doubled actually, for your forward end of year guidance on revenue. So you mentioned, your investment, your capital management, that sort of thing. But what specifically caused you? Is it that the underlying royalties that are paying you are coming in with higher rates of profit to Vox than you expected, or is it that you're going to have more under management than you expected to by the end of the year? What's causing the change?
It's really a combination of all of the above. We've had assets move faster into production than we expected. We've had assets increase production significantly. And then we continue to have just the backlog of development stage assets that are coming online, usually faster than expected. So it's really a combination of higher prices, more assets in production, and frankly, just greater production from these assets. So what we're seeing is, and this is, kind of to bring it back at a high level, you continue to see mining companies motivated by these high prices and the expectation that prices are going higher to increase their drilling and to increase the size of the resource and the reserves, and then to bring a lot of those ounces or a lot of that tonnage forward. And that's what we're realizing. So we're realizing greater production at greater prices that really exceeded what we had in our model and what I think the market expected from some of these assets. And so that just continues to compound on itself. And we're seeing that with mining project after mining project that we have a royalty over our portfolio, where this overperformance, because of the higher prices and the expectation of continuing higher prices, is really motivating the mining companies to bring that production forward and increase the total resource and reserve base that our royalties cover.
And the full aspect of this announcement, it sounds like it's quite remarkable. I mean, a lot of companies that do issue forward guidance and then come out and have to amend it or restate it, they might make incremental adjustments to it, but to double the year's guidance is quite remarkable. You kind of warned us that this might be possible. This kind of thing can be possible. This kind of increasing revenue to streaming companies. Can you talk to us just real briefly about how in this commodity super cycle that we find ourselves in, I think that's where we started our first conversation together, how that is likely to benefit companies like Vox?
Again, I'm biased, obviously, but I think the royalty model is the best way to play an expectation of inflation and higher metal prices. And a lot of that stems from just really free optionality in the upside of these mining operations. And at the end of the day, that resulting in increases in production and more significant revenue on deeper life of mine operations. So at the end of the day, royalty companies get that at no additional cost. But we're also not exposed to the rising cost structures of mining companies. And I think that's a really big issue is, yes, revenue will be increasing for mining companies, but the problem is so will their cost structure. And for royalty companies, you're getting a pretty stable, pretty fixed cost structure that isn't really affected by what we expect to be as very significant inflation. So you really get that free optionality without the cost structure and that exposure to inflation, which I think is really, really beneficial for investors. And we're seeing that play out for the shareholders of Vox Royalty Corp.
I'd like to play a devil's advocate here for a moment. A couple of assumptions that get made, well, actually a lot of assumptions get made because you try to model what you expect to happen. Anybody in business tries to make decisions based on data in that way. What if, and this is what a lot of our viewers are, I would say painfully, or at least certainly aware of as investors in precious metals directly, physical holders, that there seems to be this sort of this range-bound behavior, at least for the time being, of like gold and silver not doing convincing breakouts since they set nominal highs, or at least gold did third quarter of last year. So what if we don't see a major move upward in near term in precious metals prices, number one, and then number two, this whole inflationary assumption, because we're, according to the officials at the Fed and so on, we have transitory hyperinflation due to supply chain disruptions with COVID or whatever, but that may not persist. So if the environment forward is, I guess, pessimistically from maybe your standpoint, not increased metals prices and not increased, inflationary pressures in the economy in general, how does Vox look to that environment, if that's the way it plays out, given the number of assets you're expecting to bring online, et cetera, as far as whether you still expect to be able to grow revenue and that sort of thing, even if gold price doesn't go up or commodity prices don't continue to surge?
Yeah, I mean, we touched on a part of this before, which I think physical in a portfolio of assets for any investor that is trying to really create a diversified portfolio, and there's a lot of benefits to that. Physical, I think, always makes sense. And I think we all know this fact that most of your investors around the world are underweighted to holding any type of physical. So I think that is, will continue to be wind at the back of precious metals. But what I think investors need to consider when they're looking at the equity markets and how do they play equity markets as it relates to commodities, a royalty company like Vox, we're not pricing in rising metal prices. We are pricing in actually metal prices contracting, and we're using what we call in the industry a long-term consensus price deck. And those are usually very, very conservative price forecasts in terms of the future-looking prices for precious metals, base metals, consumption-based metals across the board. So with Vox, you're getting the benefit of us creating what we call alpha in the royalty sector, which is we're looking for the best priced royalties around the world. And we're pricing those royalties on an expectation that metal prices actually fall. Now, we believe that prices are going to rise, but the best way to price a royalty and lower the risk of what you've priced into that royalty is to use a lower metal price. So by and large, a lot of assets and a lot of companies in the mining sector go into production on the hope that metal prices continue to run. That is not the way we run our business. And so what that means is Vox is a much less riskier place for capital because we don't need metal prices to go higher for us to continue to deliver on the revenue growth that we demonstrated and the growth in the underlying portfolio. So that's a big difference between us and a lot of other investments is we should continue to do very, very well for our shareholders because we're very disciplined allocators of capital. We're picking the best royalties at the best prices using a consensus deck that is lower than today's metal price.
Yeah, a couple of things you just mentioned triggered a thought in my mind. Rick Rule from formerly Sprott Asset Management, now of Rick Rule Investment Media, who just had the 2021 Natural Resources Symposium again this year, stated something you just alluded to, which was still 0.5% of the overall size of people's investable net worth is in any natural resources directly or in natural resource related equity. So it's just remarkable how tiny the precious metals slice is of the financial investing pie still. And it'll be quite interesting to see how that plays out going forward. The other thing he talks to us a lot about is return on invested capital. In fact, I think he's brought up that term almost every time we've interviewed with him. So we're going to put you on the hot seat here. We like to ask our guests to define a technical term that may not be familiar to all of our viewers, and I get to learn for free along the way by asking these questions. So I'll ask you, what is return on invested capital, ROIC? Why is it especially important in deciding whether to invest in a royalty company?
So it's not a metric that the industry uses on a very common basis because most of the industry I would say they pay a lot for the assets that they buy, and it is really an option play. It's an option on higher metal prices. It's an option on resource and reserve expansion and again, mine life expansion and production increases. The good news is royalty companies do indeed benefit from that. But the reality is a lot of royalty companies, because of the addition of so many royalty companies in the market, are having to pay very, very high prices for the assets that they're acquiring. And what that means is their actual absolute return on capital used to buy their royalty portfolio is usually very, very low. That being said, they get the benefit of optionality. So there's an option premium on a lot of these royalty companies. And that's why you see a company like Franco-Nevada trade at more than 2 times their net asset value, is because there's embedded option value in those portfolios and pretty significant option value. Vox is a little different. We look at what we're buying and we look at it and say, it needs to stack up, not just on option value, but on an absolute basis. What are we buying? And what are the expected returns of that, both in the short term in some cases and over a long-term basis? And so we've deployed about $30 million into our royalty portfolio. And analysts have us, they had us going from doing $2 million in revenue this year. Obviously, we've doubled our guidance to between $4 and $5 million in revenue. They had us doing $6 million in 2022 and $8 million in 2023. Let's go with those numbers. I think it's safe to say, or I think we're cautiously optimistic that we'll be in position to deliver on those analyst forecasts. But let's use that $8 million 2023 mark over $30 million of invested capital. That would put us, I believe, at the absolute highest end of the range in terms of what we're generating on a long run basis, revenue and return on royalty for invested dollars into royalties. And so that's a metric that we watch very carefully. Most in the royalty sector will not want to kind of detail what they expect that number to be. But in our case, I think we've really delivered on that mandate to be good stewards of capital and capital allocators.
If we could get into a couple of viewers' questions that have been submitted ahead of your arrival here and see if you can answer some specific questions that they're wondering about. Ivancho says, as ESG gains in importance, how does this affect Vox Royalty, particularly in environmental terms? Are you immune to the carbon credits due, if applicable, to of the businesses you get your royalty from, or does this impact Vox?
Look, everything kind of becomes a circular iteration where the focus on ESG, look, it's certainly a part of the, I would say, focus for investors now. And what that at the end of the day means is that is driving up prices for mining companies, whether that's for the money that they need to be reinvesting into social activities or being tighter on environmental standards, you name it, it's driving up costs for mining companies. So there's the economic component to that impacts us. And then there's also the component to that, which is we want to be fundamentally very sound when it comes to ESG best practice. So what we look for is we try to avoid buying royalties over projects that we think are going to have the ESG problems that can persist over certain projects in certain jurisdictions. I'll give you an example of that. We've looked at some pretty significant royalties in Chile, and water rights are a big deal there, and the impact that it will have on local communities and the pushback that some of these operations get. That becomes what maybe 10 or 20 years ago was not as much of a concern as absolutely a concern today. But what is going to end up happening is the more required of mining companies, the more that's required of mining companies, the more that that's going to impact metal prices, because at the end of the day, those prices will get passed on to the ultimate consumers of metal. And that's going to mean prices are higher. So it's significant. It's very difficult for the mining companies to manage. We need to be very careful about what we're investing in, and try to be as sensitive as we possibly can to certain ESG principles, and we're doing that. But I'll tell you, the overall, anytime you're increasing regulation, increasing scrutiny on any industry, but especially mining, that's going to mean that prices of those underlying commodities are going to have to react to that. And it probably means prices are going up on an apples to apples basis.
Having said all that, how does that affect royalty companies that have the royalty contract with those producers when that happens?
Look, we're kind of a unique business model in that we're buying royalties predominantly from third parties. So these are not, and we've spoken about this, I think, on prior shows, these are royalties not held by the operator. And so we don't ultimately control what the operator does. And so it really comes down to a due diligence initiative for us to understand, does this underlying operator, not who we're buying the royalty from, we're not financing mining companies. So our ability to exert control over their ESG best practices, can be is not existent. But what we can do to control kind of ESG exposure is be picking underlying assets that we'll have royalties over that we believe are really, kind of leaders in the various components of ESG, and especially the environmental and community aspects of ESG. And so that's what we're doing.
So we have another question here from Icy Noob Peoples, who says, will Vox increase, you mentioned geographical diversity just a few minutes ago, and I think you talked to us extensively about that the first time we met you. Will Vox be increasing their positions denominated in Canadian dollars in the short term, 1 to 2 years?
Yeah, I think we have an interesting little play for investors here. I've had a couple investors with this question. We hold most of our balance sheet is in Canadian dollars, but also our stock is predominantly traded on the TSXV. And I think we've seen over history, these types of environments have been pretty friendly to the Canadian dollar and probably worked against the US dollar. So I think there is, if that's what your viewer is alluding to, I think there is a little bit of arbitrage opportunity just in, some immediate devaluation of the dollar versus the Canadian dollar. That's not ultimately what, we're say outright focused on, but it is a byproduct of kind of our current environment.
Before we wrap, we want to make sure we give you a chance to make sure that we've got the key takeaways. What's the key point that you think we need to understand about your new announcement, your new press release you just came out with this week? And by the way, we'll make sure and get a link to that press release and put the link in the description of this video so that people can read it themselves. So could you hit us again with what you think is the key takeaway people need to understand about that?
Yeah, happy to do so, Dunnigan. Look, our royalty portfolio continues to outperform. I think I've said it on the show every time I've been on now. We have, and we've been on a few times because we continue to have this type of news flow generated by the really good royalty purchases that our team is generating for our shareholders. And really across every major metric, we continue to outperform most of the industry. We continue to have a backlog of opportunities that we'll be bringing forward for our shareholders that are going to be very exciting and continue to increase the value of the portfolio and what I also expect will be realized in the share price. But your investors and your viewers are looking for ways to invest in this macroeconomic backdrop that we find ourselves in, which is tricky. It's not an easy environment to be investing in, but Vox was built for this period of time where you could rely on a team of mining experts and technical experts to generate alpha in a little subsector, the royalty sector of the commodity space, to really, I think, present a great investment opportunity for your viewers. The royalty space is not well understood. I hope that you and I, in having the opportunity to be on the show, have started to educate investors out there that this is a really good place to invest in this type of environment. And like we've just seen, Vox continues to outperform expectations. And at the end of the day, I expect that to increase the wealth of our shareholders.
Well, I'm learning at least as much, if not more, than most people here because I had so far to come so much to learn. And I appreciate that. I'm also seeing some things play out that Rick Rule's been trying to explain to me and to all of our viewers for years. And that's about the advantaged position that royalty companies are going to have in this kind of a market. So we just thank you, Kyle Floyd, CEO and Chairman of Vox Royalty, for joining us here again on Liberty and Finance.
It's been my pleasure. Thanks, Dunnigan.